In this video, I'm going to go into why PE of ones, as Monish Pabrai likes to mention, often have hidden risks which investors may not particularly see. And I'm going to go into some of these risks and how to sort of avoid them. So if any of you have recently been screening over the last year or so, this is the year 2024, coming to an end 2025. If any of you have been sort of screening as to what are the P ratio of ones or perhaps twos and threes that are trading on the stock market currently, you'll notice that there isn't that many, but the ones that are typically like tanker businesses, particularly in the micro cap spaces. I'm talking anywhere from I've seen as low as 10 million market cap to about a 1 billion, 2 billion market cap. These businesses often trade at P ratios of ones, twos, and threes. I say often, but it's quite. You do come across them in the tanker businesses, and some of the risks I've sort of seen with these businesses that I just wanted to touch up on was a couple things which aren't necessarily. These are the nuances which aren't necessarily talked about. So number one is, what is the ownership structure like? And this sort of has there's a reason why I'm looking for this, and I'll sort of mention it in the next point. But if a business has a unfavorable shareholder structure for shareholders, it can have severe knock-on effects for yourself. So for example, what I've typically seen with these businesses is they'll have common stock and then they'll have preferred shares. It might be preferred B, Series B, or whatever it is, right? And as a result, what happens is investors buy up the common stock. Oh, look, it's trading at a PE of 1. It's got this, 10, 15% dividend. Woohoo, really good, right? And then you've got the preferred stock here. So you may think, oh, well, they're not too big of a difference, right? Perhaps the preferred might trade slightly more expensive, but if you what they don't mention, unless you go into sort of the fine print, and what I mean by that is if you go on the SEC filings where you sort of go on the 10K report or sort of go into the ownership reports, you'll find out that actually the preferred stock quite often has anti-dilutive provisions, meaning that if these tanker businesses want to expand their fleet, there's nothing to stop the owners. You might think, well, the owner's invested in the business, right? He still owns 20% of the preferred shares, or he might own 80% of the preferred shares. So you might think, well, the common stock's protected, but no, it's actually not. Because if they have anti-dilutive provisions on the preferred, this means that the common stock could be protected in that sense where the preferred stock could be protected against share dilution on the common stock. So as a result, I've seen many instances where management have sort of diluted common shareholders by, I'm talking 200-300%. I've even seen as high as like thousands of percent to sort of over like a 3-year span. This is to raise money to expand their fleet, and there's no real consequences for the founder when you consider that his share of the business isn't being diluted. He doesn't own any of the common stock, and yet the investors are paying up for it. And yes, they might have like a 10% dividend yield, but what's the point if you get diluted 10 times over? So this is why you can often see these companies trading at ridiculous prices. I mean, I've seen them go as low as like 0.7, 0.5 PE ratios. But is it worth it when there's a high risk that companies could be diluted a further, 200, 300%? I don't think so. And that could just continue happening. They're the first thing. They're sort of tied together in a sense that if the founder is protected from dilution, or that the owner of the business is protected from dilution, and you're not, then they can be incentivized to sort of dilute the common stock shareholders. The second thing is the voting rights, where you might think, well, we can just sort of vote our way out of it if you take a large enough stake in the company. And what you'll see is common stock often has voting rights. So you might think, well, they've not restricted voting rights on this one, which is a good thing. But the problem is that the preferred shares often have voting rights of I've seen as much as like 250,000 votes per share. I mean, even if the total float is 6% compared to common stock, where there might be 10 times more common stock, if each vote is 250,000 shares equivalent, there's just no way you're gonna outvote them. And management will typically own like all or 80% of this preferred shares outstanding. So there's no way you could sort of turn this around in terms of a vote if you were even if you're a bigger guy coming in and sort of thinking, oh, I'll sort of try and vote my way through this. And there's actually been someone that's tried to do it with one of these smaller tanker businesses, and now they're in the middle of a lawsuit. They've sort of just been diluted a ton on their investment, and it's not really worked out too well. I think that's it in terms of the main risks. There are a few. So if you can see that these are actually that the founder doesn't have a structure where it's preferred common stock, it's just common stock, and or if they do, that they have like a significant portion of their net worth tied up into the common stock, where it's like 40% of their net worth are tied up into the common stock, and you go onto the earnings calls and they don't mention anything of any sort of dilution, or if they do, then they sort of give you like a ballpark range where it might be like 10% on the high end or something like that, then that should be all right for the most part. And you can see the balance sheet's high quality. They've got a good capital management focus. They sort of just, for example, they only want to target fleets which will only give them a high return on invested capital. They don't want to take on too much debt, as they can place themselves at risk. This is something you'd want to look for. I've seen Monish Pabrai actually started a position recently in one of his funds, and if you actually analyze that company, you'll see that it has these sort of hallmarks in comparison to the other one. Obviously, another thing you'd want to look for is, has there been massive share dilution? Now, if you just want to do a quick skim as well, what I recommend is going through ChatGPT and just sort of using ChatGPT as your tool to sort of just say, on this company, has there been share dilution? Reference SEC filings, and that will help you out massively for a large part. Obviously, do your own research as well. This is not advice, it's just sort of my opinion for education and entertainment purposes only. There we go.